Is it better to earn a 3% rate of return or a 6% rate of return? That's the age-old question. There's a lot of financial gurus out there that will tell you debt is bad, it's awful, you have to get rid of it as quickly as possible. But that's not true for all debt. So one of the things I wanted to look at today was your mortgage debt. Does it make sense to pay off your mortgage early? That's the real question. Derek Mazzarella with Gateway Financial Partners. In order to help determine whether or not that makes sense, you always have to look at the math, because at the end of the day, this is a numbers exercise. We're going to look at a mortgage with a 3% interest rate and a 4% interest rate. The thought of paying down the debt means you're paying off your mortgage early, and then after that, you're going to invest that mortgage payment. So let's say the mortgage payment is $1,000. You're going to go forward and invest that into an investment account. Then you'll earn the interest. So you pay off your mortgage early, you take that money and then start making your payments into an investment account. And let's look at that actually, see if that actually works. I took a kind of an average loan, so a loan of $300,000, earning a 3% rate of return. Let's say we're taking $100 a month and putting that towards the mortgage above and beyond the payment. If we do that over a 30-year mortgage, we're going to save just over $19,000, and we're going to pay off our loan a few years earlier. What we want to compare is the mortgage rate that we're saving and investing after the fact, or if we just took that $100 at day one and started to invest that every month. If we earn 3% in the market, we basically have a wash. You're earning almost the same amount of dollars. If we're able to earn 4% in the investment account, we're up about $11,000 over the 30 years. If we're able to earn 5% rate of return per year, we're getting a little bit bigger of a difference. If we earn 6%, we're almost $40,000 more in the investment account. And at 7%, we're earning basically double what we had if we had paid the mortgage off earlier versus investing it. Because the real difference is earning 7% per year over 30 years versus saving 3% per year over those 30 years. But what if your interest rate's higher? Let's say you have a worse credit score and your mortgage rate is 4% instead of 3%. We're still using the same $300,000, the same $100 a month monthly payment. That means we'll save about $29,000 almost in loan costs, and we'll have paid off our loan in 3.5 years earlier than normal. As you see here, if you earn only 3%, it definitely makes sense for you to pay off the mortgage early. If you're getting a 4% rate of return in the market, then it's about a wash again, still slightly better in the market. A 5% rate of return, $13,000 positive difference. A 6% rate of return, now you're up almost $30,000. And with a 7% rate of return, you're still up almost $50,000 compared to a 4% rate of return. You may look at these numbers and say, how am I going to earn 7% rate of return? Historically, the S&P 500 has averaged 8 or 9% over a 30-year span. So you can actually be a little bit less aggressive, even if you're earning 5 or 6%, and you're still probably going to make out better if you had an investment account. There's also a couple of things that you want to look at when determining whether or not to pay your mortgage off early. One of them, like everything else in life, is about taxes. If you're itemizing your mortgage or itemizing your taxes, your mortgage deduction is actually tax deductible. The numbers I showed previously do not include any tax deductibility, which means that the investment account would even be more attractive if you're able to deduct the mortgage interest rate. 2 is going to be, how long are you staying in a house? Usually, if you're going to stay in a house for a couple of years, it's start a home, you're moving to somewhere else, it doesn't make sense to aggressively pay it off early. You're usually not going to get the rate of return back for that. The other real big piece of it is liquidity. So if you're putting most of your excess savings into the house, the question is, what happens if you need the money out of that house? Basically, you're going back into debt. You have to take out another mortgage, a reverse mortgage, or you're taking out a home equity line of credit, which means you're just going back into debt anyway, and there's no guarantee that that interest rate will be as low as the one you currently have. The other piece of it is if you have all of this excess money that you're putting into an investment account, if you really wanted to pay off your debt, you probably have some extra funds in there. You just pay off the rest of the mortgage that way. You still may even have some excess cash in the investment account if you're earning enough of an interest rate. Hopefully that helps you frame your ideas on what to think about when it comes to paying off your mortgage early. Derek Mazzarella with Gateway Financial Partners. Happy to answer any questions you may have.